You need to watch this if you struggle with understanding different business types and their risks. When investing in the stock market, it's crucial to understand the different types of businesses out there. Companies are structured differently based on their risk management, fundraising needs, and growth potential. Some businesses stay small and independent, while others raise money from the public through stock exchanges. Let's break it down in simple terms. First up, sole proprietorships. These are businesses owned and managed by a single person, like your local shop or freelance contractor. From an investor's perspective, sole proprietorships are not listed on the stock market because the owner bears unlimited personal liability, making it a high-risk, low-growth model. These businesses depend entirely on the owner's personal funds and bank loans for expansion. Next, partnership firms. This is when two or more people come together to run a business and share profits. Common in legal firms, small manufacturers, and trading businesses. Investors can't buy their shares because they are privately owned by the partners. Fundraising is limited to personal investments, loans, or adding more partners. Moving on, private limited companies. These are growth-oriented businesses with a separate legal identity. While they are not publicly traded on the stock market, they do attract private investors, venture capitalists, and institutional investors. Think of companies like Flipkart or Byju's. Initially private, they raised funds from private investors before considering IPOs. Then, we have public limited companies, the most transparent business structure. These companies are listed on stock exchanges like NSE and BSE, allowing public investors to buy and sell their shares. Public companies raise funds through initial public offerings (IPO) and follow-on offerings to finance expansion, repay debt, or launch new products. Companies like TCS, Reliance, and HDFC Bank are publicly listed, meaning anyone can invest in them through the stock market. Lastly, limited liability partnerships, LLP, a hybrid of partnership and company. Partners have limited liability and the business is a separate legal entity. LLPs are not listed on the stock exchange, meaning retail investors cannot invest in them. They're commonly used for consulting, legal, and niche businesses. Examples include law firms and financial advisory firms like PwC and Deloitte. So, when investing in the stock market, focus on public limited companies because they are regulated, transparent, and open for investment. Private companies and LLPs, while crucial in the economy, don't allow retail stock market investors. Understanding these business structures helps you assess risks, fundraising capabilities, and long-term investment potential. Remember, this video is for educational purposes only. Always do your own research before investing. If you found this useful, like, share, and subscribe for more stock market insights. Thanks for watching. I am not SEBI registered and this is for learning purposes.